Volatility as a measure of risk. So, we were complaining about pension fund managers maybe buying infrastructure stocks or so forth, but they're constrained by regulation that says they have to calculate the risk in a particular way. And the risk is effectively, if I had to ditch everything tomorrow, what's the chance that I'm going to be able to cover my losses? That's a really crazy way to think. Say you buy a house, you buy the house because you want to live in it for your 30 years or whatever it is. If you had to think about the risk in terms of, if I had to ditch it tomorrow, would I be able to pay all my debts off? Well, it depends, doesn't it? It depends what the market's doing that week, or so then you end up with this very, very kind of narrow statistical view of what risk is. Pension fund managers could be investing with a 100-year time horizon. They can afford to take longer term bets on things. They can afford to have a bit of risky tech or whatever, maybe catch the next Amazon. They don't necessarily have to buy government bonds and infrastructure, but they do, because the regulation effectively says they have to, because they're the only things that are they can fit into this kind of volatility calculation. Which is a long way of saying that this very kind of financialized business school way of thinking about finance works its way out of the classroom into regulators, into the way that excuse me, fund managers, pension fund managers, whatever, organize their books, the way money flows, the way executives are remunerated to get money out, pay off, take on debt and pay it out as dividends, all of these kind of things that we've seen at Thames Water. And eventually some vital bit of infrastructure just stops working. And there are these very long kind of chains that have maybe been 40 years in the making. And they're going to take a bit of unpicking. But I think at least if we can see that that's what they are, that's a first step in being able to do that.